How's it going, investors? Ari Gutman here with the TipRanks team. Now, we are a day shy of the Consumer Price Index report being released and a couple of weeks out from the next interest rate hike decision, which could spark some market volatility, but also gives way to opportunities for those investors who can stomach the market uncertainty. Now, in order to help you out on your investment journey, our team is here to present you with 3 dividend stocks with solid reputations and growth history of overcoming volatility. Not to mention, analysts across TipRanks are rating each of them as a buy. So without further ado, let's dive right in. So as mentioned, tomorrow the Consumer Price Index report will be released, in which investors are both hopeful and optimistic about news of lower inflation. Such news is, of course, what we could all be celebrating, whether you're an investor or not. However, investors are also troubled with the Federal Reserve likely to move forward aggressively when it comes to raising interest rates, which has been creating a whole lot of fear for investors across the board. However, as Warren Buffett famously stated, be fearful when others are greedy and greedy when others are fearful. Now, I would say this is a pretty good time to actually be shopping the market and looking for opportunities, which leads to our first stock to cover today, 6th Street Specialty Lending, which is a financial lending firm focused on lending to middle market companies. 6th Street was formed back in 2010 and has loaned capital to a wide array of companies, from Staples to 99-cent stores to Da Vinci Payments and Avid Exchange, among many other clients. And since their founding, 6th Street has amassed a market capitalization of just over $1.5 billion. However, amidst our current market conditions, we can see that the firm is down on the year by 16%, trading for $18.89 per share. That's less than $1 from a 52-week low. Now, at this time, their PE ratio is at 11.8, which is much lower than several mainstream lending firms. Now, more excitingly is the amount of money being poured into 6th Street from hedge funds, as we can see increased buying activity of over $30 million from both Cliffwater and Caledon Capital. But that isn't all. Insiders are also scoring more shares of the company's stock as well over the last few months. And according to TipRanks, there has been an increase in investors across the platform jumping on the very same bandwagon as they buy more shares worth of 6th Street as well. However, it always comes down to what analysts are thinking and saying about a stock. They are, after all, the experts. And we can see that analysts are optimistic about the growth when it comes to 6th Street, as it's a strong buy with a target share price of $22 per share, which is over 16% worth of upside predicted by analysts at top banks from JP Morgan and Bank of America. Of course, until 6th Street hits their target price, shareholders will be able to collect on a much higher than average dividend yield, coming in at a whopping 8.68%. Next up, one of the largest retailers within the United States, it's actually the 7th to be exact, we have Target, which has taken a beating throughout the last couple of years as inflation rose on top of already troubled supply chains. Ultimately, Target suffered from the necessity to mark down items from clothing to more expensive items within their electronics department, all resulting in weaker and weaker earnings reports. Now, we can see the impact on their stock share price, as it was once trading for roughly $228 per share, but down now by 24%, trading for $173 per share, with a PE ratio coming in under 20 at just 19.7. Now, insiders, of course, were selling shares, but in thinking longer term, smart money did just the opposite, as we saw millions of dollars worth of hedge fund capital being poured into this retailer, most notably Ray Dalio's investment of over $116 million. Now, across TipRanks, we also found that investors on our platform favored Target and have also increased their positions with Target as well. Looking ahead, analysts do in fact foresee growth to come, with the Target share price at $194.36 per share. That's over 11% worth of upside. But we must keep in mind that such a rebound with the stock share price would take time and would also require the market conditions to improve drastically. However, as I always say, it pays to be patient, and Target is a reliable dividend aristocrat with a 2.18% dividend yield. And finally, we have the good old American Outdoors Brands Corporation, Smith & Wesson, which engages in the design and manufacturing of firearms. This gunsmithing industry leader was founded back in 1852, so indeed a long history worth of navigating market turbulence and overcoming it. It's likely to only continue to do so. Currently, Smith & Wesson has a market capitalization coming in at $575.7 million. But after a recent earnings miss induced by weak demand, Smith & Wesson remains down on the year a little over 30% as it trades for just $12.58 per share. Its PE ratio is also coming in rather low at 4.93, which presents opportunity given similar industry competitors are coming in with much higher PE ratios. As for analyst forecast, there is a $22 target share price on TipRanks, which is just about 75% worth of upside for investors interested in jumping in on this investment, which for those who do will be joining the investors across TipRanks who began increasing their position with the company within the last 7 days alone. And until Smith & Wesson actually turns around, the shareholder of this gunsmith will be collecting on their dividend, coming in at a 2.7% dividend yield. Now investors, there you have it from 6th Street to Target and Smith & Wesson, 3 dividend investments that may be worth your attention as an investor in these uncertain times. Now just keep in mind that this video was not meant to be taken as investment advice, but rather a means to show you through how our tools at TipRanks can help you as an investor make wiser, more informed investment decisions. Now most importantly, go ahead and drop a comment or two down below to let us know what you think about these dividend stocks and whether or not they're within your portfolio. And until next time, thank you for tuning in.